Hi, everyone. Thank you for participating in the virtual Propane Expo today and spending a little bit of your day with Qualpay to chat about payments. We're going to begin shortly, but as a quick note, if you have some questions during the presentation, please navigate over to the right-hand side and click on the question mark. We'll be monitoring those questions and we'll be sure to address as many as we can during the question and answer. So with that, I will go ahead and begin. With everything going on in our day-to-day businesses, payment acceptance is usually one of the last things we think about. And really, unless there's an issue, once it's set up, it often runs invisible in the background for many years. Yet it's the way we get paid. And just like other software or equipment, payment technology changes over time and should really be reviewed on a regular basis. I'm Marci Gagnon with Qualpay, and I'm joined with my colleague and good friend, Jon Gilbert. Hey, Jon.
Hey, Marci.
So Jon's going to join us. I'm going to go through a little bit of the history of energy payments, and then Jon's going to join us to dig through a statement, and we'll combine at the end of the presentation. Jon's managing the slides today, so I want to thank him for doing that as we appropriately social distance across Portland here. But today we're going to discuss what makes payments different for energy marketers, why it costs so much to accept credit cards, and how to isolate our businesses from some of the most expensive rate increases that'll hit the industry this spring. So it's always good to take a peek back on how the energy space got to this moment with payments. I won't spend too much time on this, however, it will really help with Jon's portion of the presentation, and it's always a good refresher, and I promise I'll be quick about it. So in 2005, MasterCard classified energy marketers as a utility. And a few years later, Visa followed suit and classified energy marketers as an emerging market. What that did is it shifted the industry out of a generic business category and put us into a utility services category. And that was huge because it reduced the cost that energy marketers had to pay to the card brands, and it saved the industry over $1.5 billion to date. So if we fast forward 15 years, there's been some significant advancements to payment technology. And while we're finding that energy marketers are qualifying for better rates because of the reclassification, it's surprising to know that now we're also getting stuck with a lot of compliance issues and penalties. And it's not really too unusual for fuel marketers to experience these hidden penalties and downgrades, really because of the unique way we run our businesses. So for instance, in our industry, before we send out a truck, we run an authorization to secure payment. Then we make an adjustment that match the gallons that were delivered. This isn't really common for other businesses. If you order something online, such as a t-shirt, and it comes to your house and you receive it, unless there's an issue with the delivery itself, you kind of get charged what you thought you were going to get charged for, and there's no real adjustments made. So that's kind of unique to the service industry. We also need to accept a lot of business cards. As we grow our customer base or make acquisitions, we have more commercial customers these days. And in the early days, businesses usually paid via check. And now they're utilizing their corporate cards or purchasing cards, government cards. And so those really need to be accommodated in our payment technology as well. So these examples are pretty common in our industry, and we can accept all of these types of examples, but we end up paying just a little bit more if the technology is not set up properly to accommodate. So even if the processor we're utilizing specializes in the energy space and you're set up properly with the card brands, these compliance fees could appear because of generic or outdated payment technology. So what it all boils down to is because of the technology we're using, we might be missing out on achieving the best possible rates. So just like software that optimizes our route management, payment technology plays a really big role in optimizing our overall cost. Like basic software, all payment companies kind of do the basics. But to truly optimize your route management and your internal process flows, we use specific industry software. And it's the same thing when we look at payment technology. The basics are good. You can run a payment, you can pass a token, you can do recurring payments, but technology specific to the industry will benefit you so much more in the long run. It'll allow you to do some really neat features, such as running pre-auths and still qualifying for the best rates, and doing add-on charges and those types of things. So the reclassifications in the early 2000s from the card brands, they were big. However, that was 2005, and the payment technology that most fuel marketers utilize today was created over 20 years ago, before half of the payment methods we currently use were even imagined. And since the older technology was really built for generic businesses, the energy space ends up with really kind of a large amount of unnecessary fees each month. And it's not new. These additional fees have always happened. There was just not a ton a marketer could do about them, so they were never really addressed. Well, why is that? Well, let's take a quick peek at the slide to understand payments at a little bit of a higher level. A traditional payment account is set up with multiple companies, a gateway, a merchant account, and acquirer, and they all kind of had their own rates and fees associated. In this example, let's look at the gateway, since that's where most of the technology lies. What's hooked up to your software, your customer portal, that's called a gateway. And the gateway passes information to the card brand. So this is a really important piece of technology. For instance, it makes sure that the customer has enough money on their account to make a purchase. It transmits data in a secure manner, and it manages your payment vaults for recurring billing. And all gateways kind of do those basics. So if you're utilizing an older gateway, you can do the basics, but it might not have been built to accommodate some of the things that energy marketers need today, so it's not passing enough data to the card brands. And because of this, on certain card types, the card brands are missing some of the data they need, and therefore they classify you for more expensive rates. And these take the form of those compliance penalties that we were chatting about. So you can see in the example that the gateway on the left-hand side, not all the information actually makes it to the card brands. Some of it drops off. And when we think of what types of cards we're accepting, we mostly think of just 4 types: Visa, MasterCard, American Express, and Discover. But within each of those brands, there's hundreds of types of cards. There's rewards and purchasings and debits and business cards and so forth, and they each have their own rate associated. So when the card brands receive the data from the gateway, they actually match all of that data against the card type, kind of like a checklist of things needed to put it into the best rate bucket. And if they don't have the right information for certain cards, they'll still accept it, and you can still process that transaction, but that's where they're going to reclassify you to a more expensive rate bucket. So the challenge with this is that there's not a lot we can really do. This classification happens at the card brand level, and your payment processing partner really just kind of passes that cost on to you. They don't make any more money in profit. This data is mostly passed through a third-party gateway. And some gateways do this really well. They pass the data correctly from the software and back out to the card brands. And some are really just unable to hit that mark. And still others attempt to correct the data through add-ons. And they charge additional basis points through surcharges. And when you have that, the gateway really didn't have the ability to pass the data because it was outdated. So they tried to add this add-on, but really, when you're not passing the appropriate data and they try to fix it on the back end, but then charge you money to do that, it kind of negates the benefit of passing the corrected data in the first place. So we're always kind of weary of those types of things that get added on, because it also adds on additional costs and fees. So unfortunately, most payment gateways in the energy space have challenges, and it's because they were really kind of invented for these generic business types, kind of like online t-shirt companies I spoke about earlier, or folks selling antiques or furniture online. So in addition, energy marketers are such a small segment of those businesses that it doesn't make much sense to make major updates to accommodate. So they really just make their money off of the transaction costs. So all of those 5 and 10 cent transactions at authorized.net or NMI, that's kind of how they make their money. So what that leads to is that there's no real financial incentive to update the technology to really be able to help energy marketers eliminate, some of these compliance issues. So that's where most people fit right now. Most marketers in the industry are utilizing some older gateways that allow them to pass the 2 business codes, which is super important. It qualifies them for both Visa and MasterCard. but that's just the basics. And the good news is that there's a lot of options out there, for updated payment technology. And it's not only going to save you some fees, but also provide you some good tools to help manage your cash flow more effectively. So that was a little bit of the history lesson. To get back on track here, as I mentioned earlier, in 2005, most energy marketers needed just the basics. So the basics would be card acceptance, recurring billing for subscription customers, and maybe pushing out a receipt. And that makes sense if we think about 15 years ago, because most customers were still paying via check. And those were really the basic payment needs at the time. When you think about it, smartphones didn't really come out into the market until around 2007. So this was really just basics. And those are some of the basics that are still being utilized today throughout the industry. But if we fast forward to today, to 2020, now we can take online orders. We can run pre-auths and still qualify for utility rates. We can update expired credit cards and customize processes to work with software and tank monitors to predict when to make a delivery and how much product to deliver. So there's all these really neat things that we can do now with modern technology that wasn't really considered when folks went into the space and had these payment gateways integrated into their services. So at this point, Jon is going to take a deeper dive into what some of these compliance fees are and how to isolate ourselves from some of the most expensive, and then I'll jump back in for questions at the end. So Jon?
Thanks, Marci. So securing the best rates really comes down to three parts. The part that everyone's probably the most familiar with is negotiating the fair processor rates, right? That's the basis points markup. It's maybe eliminating some third-party gateway fees by working with a provider that provides merchant services and a combined gateway. You can make some changes to how your processor rates affect your overall cost. But by and large, when you're looking at your statement, the processor cost and that markup is actually only 10%. The vast majority of your cost comes from the card brands. And Marci was talking before, Visa, MasterCard, Discover, and Amex. And so getting the best rates are actually done by either correctly classifying the industry, which is by doing the dual MCC codes and getting the utility rates for Visa and MasterCard, right? This went, so if you were accepting payments prior to these changes, when the card brands gave utilities better pricing, you would have went from getting a generic rate of maybe 2 or 3% per transaction. But after these changes happened, this industry specific rate where so if you were actually a fuel marketer and you were accepting transactions, all these different costs of credit cards changed. They all went to a flat rate price. If you're getting utility, you're getting 65-cent flat rate for utility rates for MasterCard, and you were getting a 1.43% base rate for Visa. And so you went from paying roughly 3% to 65 cents, and that makes a huge difference when you're talking about a $400 transaction, right? That's by as much as $3 per transaction. So just like you were accepting credit cards in 2005, if there was a provider that couldn't set you up with those dual MCCs to get you that much lower utility pricing, you wouldn't work with that processor, right? Even if they were giving you the processor cost for free, that is to say that they're not marking up anything, they're not charging you a gateway fee or PCI fees or anything like that, you would still be paying such a higher percentage because you would be getting these generic fees from the card brands as opposed to your industry specific rate. So why does that matter? Well, it's because you're actually only protected for a certain amount of cards. And as Marci was saying, there's over 220 or 280 different card types before the four brands, but by the four card brands. And some of these fall into utility pricing. So if you're accepting these cards, like the debit cards and most rewards cards, those are hitting the utility pricing. But if you're accepting transactions, if you're accepting credit cards from commercial entities, that's to say governments or anyone using a business card, these rates actually fall into a different classification. They're considered business cards. And those have a totally different rate structure that are not shielded by the industry classification of utility pricing. And so most of the gateways that are being used in the energy industry are not passing the right data in order to qualify commercial cards to get the best rate. And it's not getting utility rates, it's called getting B2B rates, or another way of saying it is optimized interchange or target interchange. And I'm going to show you a couple more examples here, just so you can be a little more clear. If you look into a statement here, this is just a generic statement, but one that's pretty common in the energy space. If you look on the left, the processor cost for this merchant was, an $800,000 worth of sales was about $1,500 in cost. If you look over on the right side, though, the card brand fees are so much more expensive. They're paying $9,000 in interchange fees and $1,500 in card brand fees. So as you can see here, it's about a 90 to 10 split. So lowering these card brand fees by qualifying your interchange properly is super, super important. Again, you know how important it is from going from a generic 3% rate to a 65-cent flat rate by accepting MasterCard utility pricing, but wait till you see what the difference is for business cards. And like Marci was saying before, if the payment processor you're using is using old gateway technology, they can't pass all the data to the card brands in order to lower this transaction. And again, think about it, 20, 15 years ago, if you were accepting a payment from a business, you were accepting a check. And so when these gateways were built, they weren't thinking about business cards because there weren't that many business cards around. It was the consumer cards that happened first. So working with a payment processor and a gateway that has updated technology can actually help pass this additional data along, which is called level 2 and level 3 data. When this goes to the card brands, they actually will put you in a different toll, you could say a different toll lane for fees. You're going to get the target interchange rate as opposed to the generic rate. And we'll see how this looks like in the statement. So I know if I looked at this statement, before being a trained credit card professional, I wouldn't understand what any of these card brand fees meant. I would say, okay, all these things on the right are passed over from my credit card processor, and so they must be the lowest possible rate, right? How would I know? There's really no way of knowing unless you're going to go to the Visa, MasterCard websites and look at the interchange charts. Or you could go to a payment processor and get what's called an interchange audit, where the processor, like Qualpay, can take you line by line down your credit card statement and show you all of the card rates that you're getting versus the target interchange for that. And here's an example. On the left-hand side here, so this is what Marci was talking about. You thought that there were just four. You may have thought that there were just 4 card brands before, right? But as you can see here, I'm seeing 30 different card types, and they're all Visas. And so me knowing, I'm just looking at these rates, I can see retail rewards 1, 2, 3, and see all the possible costs for all of these. What we'll do is break down line by line the card types, the cost, and we'll also show you what the optimum cost is for this interchange. This is the rate that you should be getting should you be passing all of the correct data. And I'm not going to go line by line from all of this, but I want to show you a couple of things that should jump out to you. Right here, this merchant took $500,000 worth of payments that were all on debit cards. Debit cards are federally regulated, so they all pass through at this 1.65% rate. However, a payment processor should have known that there's a $2 cap for utilities for these types of costs, which would lower the average transaction amount based on their average ticket by 1% per transaction, or 100 basis points. So just by doing a quick configuration change to the merchant's account, to the merchant account, they can save $5,000 a month. They're going to go from paying $8,600 that goes straight to Visa to $3,500 going straight to Visa, a savings of $5,000 just by configuring the account differently using updated technology. Business cards are another big one here too. As I said before, this is the most expensive card type that a merchant can accept. especially if you're not passing the interchange properly. So if you look down on the bottom here, you can see card retail tier 4, 2.5% and 10 cents, or 2.7 and 20 cents. This merchant did about $28,000 on these business cards just in these two transactions. And they could be lowering their basis points from 30 to 50 basis points on every one of these transactions if their payment processor could properly pass this data to the card brands and back. Why is this important? Well, besides the fact that this is 90% of a merchant's cost, so making sure that you're qualifying interchange properly and passing level 2 and level 3 pricing important, but what's also happening is there's going to be some changes. The card brands are increasing the rates again, and this generally happens twice a year. They usually increase your dues and assessments by a basis point or two and so forth, but in July this year, they are actually going to be passing the largest interchange hike that has been done in the last 10 years. The good news is that you can be shielded from this if you're passing interchange properly. I'm going to show you a specific example. So some of these changes are across the board, the MasterCard utilities credit and the utilities enhance in the world. These are the last 3 line items in the MasterCard portfolio that were getting charged 65 cents. They're now getting charged 75 cents. Most of these other changes here can be eliminated by using the proper technology. And I'm going to show you an example right. The target interchange rate is this rate right here in the green. So if you think about level 2 pricing, this is the B2B pricing. The actual card, the cost of card acceptance comes down to how much a card holder can spend on a given transaction. So for example, if a card holder can run a $70,000 charge, they would be considered a level 2 card. And so you have 4 tiers here, but what's really important is this target interchange chart right here. You have 1.9 all the way down to 2.25. These are the 5 different rate classes that you can get if you're passing target interchange. You're passing all of the appropriate data to the card brands. If you're not passing this data correctly, you're actually going to get dropped down into these generic payment tools, which is a 75 basis points downgrade per transaction. So anytime that you're taking a commercial card, you're going to pay 300 basis points or $3 on a $400 transaction. That's more expensive than you need to. So that's 75 basis points or 0.75% that you're giving to the card brands just by not doing these payment tools. So generally when we do an interchange audit, we find a lot of merchants are getting utility rates just from one card brand, or they're receiving this generic payment tool rate. This is how we start seeing savings of 5 and 6 figures on some of these merchant statements. Again, I apologize for not having this slide on here previously, but since that was a little choppy, I want to give some opportunities for people to ask questions. And if anyone wants a one-on-one consultation, you can send your statements to energy@qualpay.com, and we'll complete you a interchange audit.
Thanks, John. There's actually a question that came in. When do the new rates go into effect, and how often do they happen? John, why don't I handle this one? Can you scroll up just a little bit back to the pricing changes?
Sure.
Yeah, right there. So these changes actually were going to take effect in April. Usually there's changes from the card brands in April and October. This year, because of COVID-19, they've actually put a delay in it. So they come into effect right now in July. So the good news on that is that if you haven't actually had an opportunity to look to see if you're optimized for some of these changes to be able to isolate your businesses, you still have a little bit of time to be able to do that. And it looks like there's a lot of changes on here, but really quickly, I'll just go through the top 3. As John said, primarily all MasterCards were at a 75-cent flat rate fee, with the exception of these 3. So that update, while any changes to pricing is going to have an impact on fuel marketers, That one was really just aligning every MasterCard credit, not including debit, up to that 75-cent flat rate. The next one's a brand assessment. It's really small. But the next three are really having to do, four actually, really have to do with those business cards that John was mentioning. So this Discover Integrity fee, that's a 5-cent fee, and it's only if you're not passing the appropriate data for Discover. Now remember, Discover is also in that category with MasterCard where it's a 75-cent flat rate. So you don't want to add an additional 5 cents because that's actually going to bump it up to 80 cents. So what we're going to do is try to make sure that folks can remove themselves from that integrity fee and stay at that flat 75-cent for Discover. Even with these changes and upgrades, MasterCard and Discover are going to be your least expensive options, as along with debit cards, to be able to accept payments. Some of these level 2 and 3s, again, you can isolate yourself from being able to just pass the appropriate data and make sure that you're staying in line. Some of these, you should be able to pass at 2.05%. We're seeing folks passing it at 260 or even 270, and it's only because, they're unable to pass that appropriate data. The domestic verification requests, those are really small. Again, any change is going to affect fuel marketers, but those are relatively small. And then the last two are really non-issues. There's a breakout of the authorization reversals for unique billing. You already have that on your statement. It's just being put in another section, so you will see it. And the final is that international verification increase. So we put this on here because we do have a few customers that are on the Canadian border and they do want to accept international cards. In that case, there will be a little bit of an increase for some of those international cards. However, for the most part, it's really a non-issue for the energy space. So out of all of these, the ones that are going to have the largest impact on your company are really going to be the integrity fees and those business cards that John mentioned. So if you can isolate yourself from those, you're really doing quite well with some of these changes. And I don't want to be too long-winded on this one, but I will say we really haven't had any changes to the industry in about 15 years. They've really just been on the dues and assessment side, not really on the card brand fees. So last year, we did have a change on a MasterCard, MasterCard debit, and it went from 45 cents to 65 cents. And we kind of screamed it from the rooftops because we kind of saw it as, the card brands dipping their toe in the water to see if the market would bear it. And so this year, all of these changes came out. We are hoping that this will stay. And that there won't be too many changes in the future. We've been in close contact with both Visa and MasterCard, and they just felt that they needed to make some adjustments because they haven't done so in so long. But again, if you can remove yourselves from some of the most expensive, you'll fare pretty well compared to some of the other industries out there that have also changes in their pricing as well. John, we got another question in here. How do we know if we're utilizing outdated technology? John, I'll let you grab that.
Yeah, and also Shane, I saw that you had your hand raised, so if you also want to ask a question too, just go ahead and jump in. But Marci, to answer your question, to figure out if you're using the most updated technology, the really easiest way is to get an interchange audit, because that's really the only way to see if you're getting target interchange for all the card brands and all the card types. So the only way you can possibly know is by seeing line item by line item whether you're qualifying for level 2, level 3 pricing, and also the utility pricing. And then also, you definitely want to make sure that that the provider that you're using also has the tools that you need. So like some of the more the newer technologies would be like using ACH and credit cards on one platform, having an account updater, being able to automatically update expired credit cards, or having a payment page or API based or something like that too. So, certainly you want to have an understanding of the features, but really the cost is really the easiest way to show you whether you're using the updated technology or not, because the proof is in the rates that you're getting. Shane, did you have a question?
While we're waiting for him to type that question out on the right hand side, we did have another one that came in, and it says, why is it often that one report from the gateway will show something different than what's been deposited into my bank account? John, you want to grab that one?
Yeah, so generally, if you're using a payment provider that has a third-party gateway, those numbers may not match up, because what's going to happen is the reporting you get from your merchant account provider is not going to account for the gateway fees that you get. So the fees that you have on the merchant side are not going to reconcile with what happened on the gateway. And so generally, it comes down to the software provider who has to kind of reconcile that. But by using a provider that's a combined merchant account and gateway provider, can actually prevent that from happening and have that reconciliation reporting, which helps you, find your money, really, which is the easiest thing you can do with some good reporting.
Okay, let's see. We got one more being typed in here. So what are the steps to know that we're getting the best rate? Well, we've chatted about this one a little bit. The first one would be to make sure, as John mentioned, you're qualified for utility and emerging market pricing. So make sure you're getting that first. That's going to be your absolute number one way to make sure you're getting the best pricing. Second is to make sure you're utilizing updated payment technology. So make sure you're getting the best rates on all card types. Then make sure that you're set up properly for some of these new cards that are out. Remember, some of these gateways were built in the early 90s or late 90s, rather, early 2000s. And so some of the cards we use today, they were never really even invented back then. So to map properly to all of the different platforms that fuel marketers need to utilize, sometimes some of the gateways have some challenges. So make sure you're utilizing updated payment technology. And then the last one is really to negotiate your rates, negotiate your basis points. A lot of people think that's the first one. What is my rate with my processor? But as John mentioned earlier in the presentation, there's really a disparity between that, because your processing rate that you pay to your payment processing partner is really only about 10% of your overall bill. So it's important to negotiate that. But the most important things really before that is to really make sure you're set up properly, because it's really going to save you the most amount of money throughout the whole process if 90% of your bill is correct and the 10% is a good fair rate.
Yeah, that's a really good one, right? Just look at your overall cost first. What's the option that can lower my bill the most? And like we were saying before, even if certain credit card processors gave away their processing for free, if they don't have that updated technology, they're going to be passing through much more bloated rates. And so I'm sorry, Shane actually, his question came through, really good one. He's wondering if there's any specific part of processing platforms that will go by the wayside in favor of others. He recalls everybody had a terminal machine to swipe cards at one point, and those went away. That's a really good question. For one, if you're talking about utility pricing, card swiping actually doesn't matter. So you're not, you used to get a much better rate from swiping than not swiping, but since everybody's getting utility pricing that is not different whether you swipe or not swipe, I think you're certainly going to see a lot of these kind of swiper technologies go by the wayside for sure, and especially what you're seeing with COVID-19. You really don't ever need to accept a credit card face to face if you're in the energy business, because you should be able to send payment via email, have a payment portal, or be able to do it over the phone. Especially if you're using tokenized card data, right? For if you're using repeat customers, Many gateways have the ability to store multiple credit cards on file, and so when you're getting to that house, you can just run the authorization and so forth, and collect the money without ever having that card on you.
Yeah, and just to add to that, John, we're seeing a lot of folks that instead of having folks come in and pass their card over to the CSR rep, they're setting up tablets and just having them enter directly into a tablet and then Cloroxing down the tablet after. So that way the CSRs are not actually touching the cards if you do have a person that comes in person into your location. From our perspective, we always try to eliminate as much equipment as we can. I mean, obviously, pumps and those types of things, you're not going to be able to eliminate those types of technologies without enabling near field communication. However, if you've got one of those devices that you're sharing amongst a few different folks in the office because they are a little expensive, and then somebody spills a coffee on it or a Coke on it or something like that, you've eliminated it. And trying to get some of these devices now with all of the new PCI requirements, some of them are actually going to the wayside. So some of the older technology that folks are utilizing in terms of a terminal, you're going to have a hard time being able to get that exact terminal in the future, and you're going to have to probably get a more expensive one. So in our case, since there's no real benefit to swiping, it does take a few more seconds to key enter something. But since there's no price benefit from it, we would really kind of push that off to the customer, because it does take care of our reps a little bit, especially right now, being able to handle other people's cards, and also taking orders over the phone or through a portal. So great question, Shane. All right. I think unless there's any other questions, that's our presentation for today. We would love to speak with anybody that has any questions on updated payment technology, or would like to know a little bit more about some of the upcoming changes in July. And our industry has always come together to help folks in need, and this time is no exception. So we want to thank everybody. We want to thank all the frontline workers putting your lives on the line to help customers, and a big thank you to the organizers and sponsors of the Virtual Propane Expo. Came together pretty quickly, and we're fortunate to have been able to participate. There are presentations running until 4 o'clock today, so stay tuned for more great content, and stay safe out there. Thanks, everyone.